Welcome to the series of Chapter 16 videos on corporate taxable income. We're going to start with an overview, and then we're going to have a series of very short videos that cover a bunch of very small topics. Let's get started. Here's an overview of the corporate taxable income formula. We saw this before, way back in Module 1. So you can see on the left, the corporate tax formula, super straightforward, gross income minus deductions. That gives us taxable income times the rate, because there's only one now. That gives us corporate tax liability. Individuals, as we know, is more complicated with adjusted gross income wedged in there. And deductions are a matter of legislative grace for individuals, so it's either the standard deduction or itemized deductions. Okay, so typically when we're calculating corporate taxable income, our starting point is financial income. So most corporations keep their books on an accrual basis, so this is pretty straightforward. And then what they do is they reconcile their book income to their taxable income. And for those of you that have had Professor Machado's Intermediate 2 course, you know that there are book tax differences between net income for book and net income for tax. Of course, if the company's preparing its financial statements under a tax accounting method, then there won't be any differences. But that's only true for small companies. Okay, so here's what the corporate income tax return looks like. This is the top half of the Form 1120. And you can see that, like most tax forms, it's got some identification information on the top. And then it starts lines 1 through 11 are listing basically the gross income of the corporation. Lines 12 through 27 are all the business expenses, but there are a few special ones located after that. So line 28 is taxable income before the net operating loss deduction and special deductions. And we're going to talk about both of those in this series of videos, but not in this video. So net operating loss, line 29A, the special deductions on line 29B, that's actually the dividends received deduction. And you'll see that comes from Schedule C, line 20 of Schedule C. If you look at if you look at Schedule C, you'll see that is the dividends received deduction. Now this is a 2017 excerpt of the form. The 2018 percentages will be a little bit different, but we'll get to that when we get there. So when we are reconciling book income to taxable income, because that is such a common occurrence with most corporations, there is in fact a section of the 1140 that requires the taxpayer to do so. In small corporations, it's called the Schedule M1. In large corporations, that's called the Schedule M3. And the M3 is still a reconciliation from book to taxable income. It just has way more detail. So let's look at an example of a reconciliation from book to taxable income. So we have Ravenclaw Corp., whose net income per books is $1 million. The first thing you almost always add back is whatever the federal income tax expense is on the book basis. So if you recall anything from ASC 740 and Intermediate 2, you know that the income tax expense on the financial statements is only partially related to what actually goes on the tax return as income tax liability. But neither here nor there, whatever it is, you have to add it back to get the pre-tax income. So the next adjustment I've shown is depreciation per books versus depreciation per tax. And in this case, tax is greater. But think of it as you're adding back the book deduction, then subtracting the tax deduction. Since meals are at 50%, that's a pretty common add back. You're adding back the 50% that gets deducted for books that you can't deduct for tax. Municipal interest is income. The books don't care about its character, but tax does. And so since that's tax-exempt income, it actually gets deducted from book income. Legal reserves, as you recall under the all events test, since economic performance hasn't occurred with respect to a reserve, those have to be added back. And then bad debts also are not deductible until they are completely written off, and so until they're worthless. And so as a result, any allowance for bad debts needs to be added back. So you can see that drives our federal taxable income of about $1.16 million. So we can also take these amounts and we would be required to reconcile them on a Schedule M1. So I've done the work for you on the Schedule M1. You'll see the line 1 is the net income per books, line 2 is federal income tax per books. And then what happens is the M1 breaks these reconciling items down into 3 groups. And if you look, each one has a line. So line 4, income subject to tax not recorded on books. Line 5, expenses on books not deducted for tax. And you can see we have some items in there, our meals, the legal reserve, the bad debts. Line 7, income on books not included for tax. Well, tax exempt income is a great example of that. And then the last one, line 8, deductions on this return that are not deductible for tax purposes. And since our depreciation is generally accelerated for tax purposes, that's often a line there, and you'll see it on 8A. So you just do the totals and you get to the exact same income we reported on the previous slide. Okay, our next step is really to break down and talk about some of the unique differences between calculating taxable income like we've done so far, which has kind of been more or less on a generic basis, and for a corporation. That's the end of video 16A. Thanks for watching.